Thanks for clicking. The Canadian Real Estate Association, the CREA, has just released its data for the month of November, showing a real estate market that is continuing to slow down, with sales and prices dropping. Or, as put by CREA economist Sean Cathcart,
yeah, well, it looks like the start of the turnaround, or at least stabilization.
He's back.
Indeed, and the enthusiasm isn't just over the CREA's interpretation of its own data. As we'll see today, during its year-end interview, the CREA is well in line with those predicting multiple rate cuts in 2024. Surprisingly, even a bit more optimistic than those.
Talking about cuts in maybe March or January even.
You're my best friend.
Yet, amid the massive drop in bond yields that we've seen over the past month and a half, some are predicting that the Bank of Canada may not move as quick as many are anticipating. So what I want to do today is go over Canada's real estate data for the month of November, take a look at whether or not that data matches the interpretation being offered by the CREA, go over Sean Cathcart's year-end interview, and then discuss what to look for next from the Bank of Canada. Speaking of next from the Bank of Canada, the Governor is expected to speak on Friday and have a press conference thereafter, and we'll obviously have an update out on both on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price is the price of a home that represents the most popular set of features. The benchmark was down in November. In October, that benchmark was sitting at $743,700, and that dropped to $735,500 in November. So that's about an $8,000 drop in the benchmark price, bringing it back down to where it was in May, when it was sitting at $734,800. And the average price declined in November as well, maybe even a little bit more. The average price in October was $656,100, and that dropped down about $10,000 to $646,134 in November. So that's about a $10,000 drop in the average price in November, down $80,000 from when it hit its peak in May, and back down to close to where it was between January and February.
It was quite unlike anything I'd ever dreamed of.
With that said, inventory is falling, with listings down from 858,000 in October to 843,500 in November. And CREA economist Sean Cathcart attributed the drop in listings to there being so few buyers.
But September was the peak, and since then, with so few players taking the field, if you will, on the buyer side of things, sellers are increasingly picking up their ball and going home.
Now, I think it's worth noting that listings do traditionally fall in the month of November, as nobody really wants to close before the holidays.
I cannot believe you only think about yourself.
So, what you really want to do if you're trying to identify market trends, major changes in the market, is compare apples to apples. Novembers to Novembers. And the CREA full well knows this, though it doesn't publish the previous November's listings in its dataset. However, if we look back at its previous publications, we can see that in November of 2022, listings fell 1.3%, were up 3.3% in November of 2021 as sellers tried to beat the rate hikes. Listings were again down in November of 2020 by 1.6%, down 2.7% in 2019, and down 3.3% in 2018. So a 1.8% drop in listings in November does not necessarily mean that sellers are picking up and leaving the market. Sellers usually drop off in Novembers. In fact, if we look at the sales to new listing ratio, it's sitting at 49.5. So less than half of the homes that do come to the market are selling. And that number is at its lowest point than it's been for the past 5 years. So, it's not clear that November's data is telling us that there's anything out of the ordinary happening. Anything out of the ordinary to the upside. With that in mind, demand for homes just isn't there either, with sales down 0.9% in November, compared with last year when sales actually increased by 0.6%. And on this, Cathcart actually makes a decent point.
I hate myself.
If we were looking for distressed sales, anticipatory selling, we would expect to see more sales at lower prices.
If you look at these low sales numbers with prices that are holding pretty firm, obviously if people were having to sell their homes en masse, you'd have way more sales, but way lower prices. We're not seeing that.
So we are seeing prices fall, prices continuing to fall, though not at a substantial pace. The CREA sees a lack of listings as a sign that sellers are leaving the market, but as we saw, a lack of listings is completely normal for November. With that said, we're not seeing massive signs of major stress in the Canada-wide market. We might be in Ontario, but I've gone over that in other videos. However, Cathcart then moved on to 2024 interest rate expectations.
Just in the last month or so, we've gone from markets that were pricing in the first cut maybe in the summer of 2024. Now the consensus is April.
And yeah, that's true. Bond yields have fallen by over 100 basis points in just over the last month and a half. And as to when those rate cuts are coming, the CREA does seem to think it will be in time for the spring market, maybe even earlier.
And possibly, I mean, it changes, but possibly up to 100 basis points of cuts next year. That's new. So, it really could be a more active spring market than maybe we thought not so long ago. And even most recently, there was talk from a small but not insignificant minority out there talking about cuts in maybe March or January even.
Yet, Cathcart does not, at any point in the interview or on the website, indicate who this small minority is. Money markets are expecting rate cuts to begin in April. The Bank of Canada's most recent survey of market participants shows no cuts until at least April as well. TD says mid-2024, and RBC says not until Q3. So, it's not exactly clear where Cathcart is finding this not insignificant minority.
I got a little tip for you.
If you're going to say something outlandish, reference a source. Speaking of credibility, Cathcart noted that although the Bank of Canada came out with hawkish language at its last rate announcement, it's only going to be able to do that for so long before people stop believing them.
Talking about the potential still being there for rate hikes. That was expected as a way to sort of manage and rein in those evolving rate cut expectations. But it was probably the last time they'll be able to use that messaging with any credibility.
Where the do you get the
Yeah, and as we talked about before on this channel, when you're looking for credibility on rate cuts, go to Sean Cathcart.
The Bank of Canada is increasingly signaling that rates are now at the top. So buyers are likely feeling increasingly confident in taking on variable mortgage rates again.
But I digress. Cathcart is correct in that it is starting to look like we might see some rate cuts in 2024. Though whether or not we'll get them in time for the spring market remains to be seen. As mentioned, bond yields are down massively since October, down 110 basis points, and although fixed mortgage rates haven't fallen as much as of yet, if yields remain low, it's more likely than not that mortgage rates will follow. Yields are at their lowest point that they've been since May of this year, back when a decent 5-year fixed insured mortgage rate was sitting at 4.69. If fixed mortgage rates follow yields, that's going to be a fair amount of financial loosening, which is no doubt likely to draw the attention of the Bank of Canada, the same bank that has said it expected house prices to fall further than they already have. As such, many are saying that the Bank of Canada may wait longer to cut rates. Aha! You're right. Doug Porter of BMO Capital Economics recently said that there's an argument to be made that the Bank of Canada could wait longer to cut rates as the markets are loosening financial conditions for them.
You're like a wizard.
No, it's easy. I'll do it again. Derek Holt of Soctiabank recently said that the financial markets are on the path towards reigniting housing imbalances, tamping down how monetary policy works through mortgage resets, inflaming further government spending, and driving concomitant inflationary pressures. So the argument being made by both Porter and Holt is that as bond yields fall, it gets cheaper to borrow, it gets cheaper for you and I to take out mortgages, take out fixed rate mortgages, borrow and spend, which could reignite both the housing market as well as Canada's inflation rate. As such, with the bond markets pushing down fixed rate mortgages, decreasing the cost of borrowing in anticipation of rate cuts coming from the Bank of Canada, they could in fact delay those rate cuts coming from the bank, as the bank is going to be unwilling, or at minimum nervous about, adding more fuel to the fire. And yeah, as we just saw, bond yields are down, back down to where they were during the spring market. The same spring market which, at least in part, caused the Bank of Canada to raise rates again in the summer. Whether or not we will see a pushback from the Bank of Canada over fears that financial conditions are loosening remains to be seen. But we will continue to track Bank of Canada policy on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.